In this video, I'm going to explain the concept of a high two entry, which is a great strategy for day traders in order to participate in moves, whether it's a spike, a channel, or a trading range. In this video, there's going to be 6 drills, so there's loads of value, plenty to practice, and I'm sure you'll get a lot out of this video. My name's Tim Fairweather. I'm a professional price action day trader, and in this video I'm going to help you understand one of my favorite trading setups, the high two. It's a version of a two-legged pullback after a spike. Now, for those of you that haven't already watched my previous spike videos, I highly recommend them. Of course, I'm biased, but I cover spikes, spike high ones. I talk about a free indicator for TradingView that can help you identify spikes. I also talk about an indicator that can help you to look at stop entries. And now we're getting into my videos where I'm going to combine areas that I've already covered, like building blocks. So we're going to look at the spike and the stop entry and a two-legged pullback to combine to create the high two. So where does the expression high two come from? Well, it comes from Al's books. In particular, he details it in trading ranges. This is book 2, and you're looking for, at least in my version, chapter 17. So let's discover what Al talks about in high twos. So the first thing he talks about is that every correction has 2 legs. And I covered this concept in my video on pullbacks, the progression to becoming a profitable trader. I had to learn to hold the tendency to press the button and instead wait for a pullback, at least 1 leg, sometimes 2 legs, to get those sweet entries. In the first video, I talked about breakouts and high ones. So we get to a new high, we've got a pullback, and we've used our bar counting ability to see when we go above the high of a prior bar. Placing an order above this bull bar, we call a high 1. Now, if the market then continues down lower, the next time we go above the high of a prior bar, we call this a high 2. But there are many different kinds of high 2s, and I'm going to go through a couple of them now. So let's talk about high 1s and high 2s. This bar goes below the low of that bar. We don't go above this. We do go above this bar. Here's a high 1. Now we keep going higher, and then we pull back below this bar. Now we've got a new high 1 as we go above here. We go up to a new high. We're pulling back. We go above the high of that bar as a high 1. We're pulling back, we're pulling back, we're pulling back. Because we've already triggered a high 1, when we go above the high of a prior bar there's a high 2. Same again here. Up, pull back, new highs, pull back below the low. Here we've got a two-legged pullback before going higher. Here we've got another two-legged pullback before going higher. This two-legged pullback here is flat. Here is a bull spike on the way up. Pullback 1, pullback 2. There's your high 2. Market's going up, pulling back. The first time we go above the high of a prior bar is there. Now we're going back up again. Here we've gone above the high of a prior bar. Now we've gone below the high of that prior bar. So there's a high 2. This is one of those flatter pullbacks again. So now you know what a high 2 is. We're into the first drill. So drill number 1 is to go through 10 to 20 charts, just marking high 2s. You can pause me and come back when you're ready. Now, not all high 2s are good to trade. At the moment, we're just practicing bar counting and we're looking at pullback legs. When we go above the high of a prior bar for the second time, sometimes that's a bear bar, sometimes that's a bull bar. Sometimes it's a weak bar, sometimes it's a strong one. Now we're able to count the high 2s. Now we're going to be able to distinguish between which is probably a better signal and which is not. Because most high 2s are forming in some kind of a bear channel, it would be better if there are already bulls in the market before for me to then buy above them. This is a stronger high 2 because this goes above a bull bar down here. This is a weaker high 2. It goes above a bear bar. We never went above that bull bar, so that doesn't count. The next time we go above a bull bar is there. That's the stronger high 2. You can see that act as support. Market's going higher up here. We pull back, go above, that's the high 1. We pull back, go above, that's the high 2, but that's a bear bar. The first time we go above a bull bar is up here, and that became the support for later. Same again, the market's going higher. We're pulling back very tightly. That's the first time we go above, 1. Now we go lower. We don't go above that bull bar. We do go above that bear bar. That's the high 2. We've called a weak high 2. That's the high 2. We've called the strong high 2. On this chart here, we're going up in a bull spike. We've created a new high. Now I've called that a high one because it's an inside bar, but even if you didn't count that as the high one, the first time we go below the low of a prior bar is there. You're in a similar entry. We've got a new spike. We're pulling back. There's the high one. There's the high two, and it's above a bull bar. So we've called it a strong high two. New high up here. We go above a bar there. It's a high one. We go above here. I've called it a weak high two because it's a bear bar. The stronger high two is up there, even though it failed. Now you're going to start to notice that taking the high two up there was probably not a good idea. Would have been better to wait for a breakout. Instead, traders waited for a two-legged pullback on the 15-minute chart, which was their entry down there. But we'll get to that in a new drill. I'm showing these examples so you can get an idea that when we remove market structure, it can get a little bit ridiculous, but the price action stays the same. So now we're going to move into the second drill. We're going to do the same exercise again, looking at high twos, but I want you to be able to take a look at whether it is a stronger or weaker entry. Now you might have started to notice that without market structure, it starts to get a little bit ridiculous. So what we're going to do is we bring a little bit of market structure back by looking at trend lines. In my blog post here, I'm saying it can get ridiculous without trend lines. High ones and high twos break very small trend lines. And by looking at that, that's going to prevent us constantly buying in a bear channel or high in a bear spike. Here, I've got the 5-minute chart over there, and then I've got the 1-minute chart over here to give you an idea. This channel line on the 5-minute chart, that's the end of one leg. On the 1-minute chart, you can see the detail. Interesting that a high 1 on the 5-minute chart is a high 2 on the 1-minute chart. Then the bears get a new spike down. You could draw the trend line here. I've drawn the trend line here because this is so strong. I want it to be very clear that this spike is finished. And the second time the bulls break out is actually the high 2 over here. So you can see if your entries were up here, these entries made it very clear that the bear move was over. What about here on last night's price action? We've got a bear spike. We go above, that's a high one, but you can see how tight this trend line is going down. This looks like a second leg trap, so no one really wants to buy all the way up here. They probably want to buy lower. The market waits for the bears to resume. They're resuming in a bear channel, which is the same over here. The bears get a new spike to a new low, which immediately reverses. Now that immediate reversal is the high 2. But if you didn't take the trade down there, a lot of traders waited for the spike up and then started to buy up here. Now we know it ultimately failed, but this was a safer place to enter. You had a chance to get out break even. You can see here, aggressive buying of the high 1 is a bad idea below the moving average, but starting to buy the second attempt or even waiting for the second attempt and then looking at seeing what comes after it was a really good idea. The high 2 was probably down here. It triggered and you had a chance to actually buy the high 2 again later. Apologies for the low resolution. So now that we're using the concept of trend lines, you can see it's not a great buy above here. It's not going to be a great buy above there either. And that's because this is very tight. The bulls never managed to close anything very strongly up there. So the second time they do it, I'd prefer to wait to see if the bulls can actually make money. It was better to be short, waiting to sell that bar. And then if you use the same logic all the way down, you would have avoided taking any buys in here, so you would have stayed short. So that's how you can use a trend line to filter out better entries. So now we're on to drill 3. Did the high 2 actually break a trend line? Did the high 1 even break a trend line? Now you've got a way to look at which entries are going to have a better chance at continuing the original move and which are just pullbacks in a bear move. Try and find all the entries on 15 or 20 charts. Pause the video and we'll see you back here shortly. So now you're starting to see, hopefully, that there are good signals, bad signals, strong ones, weak ones. We can see entries where the bull move is going to continue, most likely, and we're in a pullback of that move. And in other cases, we're actually in a stronger bear move, and it'd be better to leave those pullbacks. Now we're going to start to blur the lines between good, bad entries, high 1s, high 2s. This is what I call the high 2 is just the second best entry. So rather than waiting for a high 1 to trigger, for it to go below, and then wait to set up a high 2, often the high 2 is the second best entry. That means we're going up in a bull spike, we've pulled back to create a high 1, it's not very good, but then we create a good bull bar. I think this is also a high 2. It's the second chance, really, to trade the high 1. This is a slightly different drill, and you're going to find this is going to be very useful to get into moves where the pullbacks are not deep. In other words, the spike's strong, I want a reason to get in. I don't want to have to wait for a second big pullback, because then it's more likely to be a channel. Let's take a look. We're going down, here's a high 1. We're going down, here's a high 2. If you didn't take the high 2 there, what I called a weak high 2, and I called this the strong high 2, this is the second entry. So if you didn't buy that, you now have a chance to buy this to get long. We've gone up now and we've pulled back. There's the high 1. If you didn't like buying above that bar, now you've got a really good bull bar. That's the second entry, the high 2. New high, pull back. If you didn't buy there, you waited for a follow through bar, you could buy that, or you could buy that. Market's coming down. You probably don't want to buy above that bar immediately because it's a high 1. This is sideways. You have an option to buy there. If you didn't take that, this leg was strong. It probably needs a second leg down. Here's a second leg down. You can buy above that. You can buy above that. So I'm trying to push the boundaries for you so you can take something that's very, very precise, but also be able to apply something that's constantly moving as a foundation, and then that way you'll have more chance of taking better trades. So now it's your turn to practice. The high 2 is just the second best entry after the high 1's formed. So feel free to pause me and then go and knock out 5, 10, 15, 20 charts until you understand this concept. I'll see you soon. Okay, so welcome back. So now we're gonna even blur the lines a little bit further. If you have practiced all the drills before, now you'll be ready for the next concept, which is where a high 2 is actually the second attempt to reverse failing. So the market is going up, then there's a pullback. The bears have one attempt to sell off, that ends. That's the high 1. The bears have a second attempt to sell off, and then that fails. That's the high 2. With this kind of understanding, now, no matter what the chart is doing, we're able to kind of blur the eyes to see what's happening. This is what I also call a high 2 on a higher time frame. Let's take a look at some charts. So here we can see, I've written as a trader becomes more familiar, you can use it as a way to practice patience. You're waiting for the bear pullbacks to finish to get in. You're not in a hurry to buy high. On this chart, here's a spike, but it's overlapping and it's not really clear. You might not look to buy the high 1 and high 2 up there. You might decide that this is a trading range and the two-legged pullback might be deep. This channel only breaks here and then goes higher. It then forms a second channel and breaks here. What's interesting is that this will be a high 2 on a higher time frame. If this is the 60-minute chart, probably on the daily chart, looking to go higher. You see a strong bull spike. There's a high 1. Technically, there's the high 2. But you might decide that this is so strong, this probably needs a second leg. You're expecting this to get a second piece, but also 50% of that move is down here. This attempt to reverse fails once. This attempt to reverse, it starts to failing around here. And whether you bought here or here, you got your second leg up. The market pulls back strongly, one attempt to reverse, second attempt to reverse but a bear bar. You never got a chance to buy above there. Now you're buying at the moving average. Now you got a strong signal bar there. These are all good attempts. So now the same concept of a two-legged pullback to go higher can apply to way more bars. Rather than getting caught up counting in here how many high 2s, high 7s are happening, you think, well, on a higher time frame, this is a big piece. If that's a big move up, anything that's a 50% pullback is going to be okay. I'm waiting for a trend line to break here, and then I'm waiting for a trend line to break here. Well, it's your turn to practice again. Now what I want you to do, and you can use a higher time frame to the side if you want to, but I think it's more useful to practice it on a 5-minute chart, or the time frame that you usually practice on, and see if you can pick up those two pullback waves so you can actually match the high 2 to the price action that came before it, rather than zooming in too much into the bars and taking a bad entry. So feel free to pause the video, and now you've got 5, 10, 15, 20 charts. See how you go. Well, now we're into the final section of the video. What happens when a high 2 fails? Well, when a high 2 fails, it often leads to a measured move down. One of the reasons I like the high 2 setup is it's a high probability setup, and when it fails, it also leads to another high probability setup, which is the measured move down. And it usually gives you a chance to reduce the loss that you took earlier or get back in the green. I've made a note here. Sometimes the entry for the high 2 is just too high in the range. Here's a strong spike. Do you want to buy above that bull bar? Well, you can. This has had a couple of legs up. It might be better to wait for something at the moving average. That one never triggered. This is a doji, so you might not buy above that. You might buy above that. If you did buy above this bar here, this follow through is really bad. Now you've got a bear bar. Now you've got another bear bar. At some point, when all these 3 bear bars print, even though you've got a stop down here, you might decide to exit that trade or even reverse. As soon as traders saw that this wasn't going to happen, the market collapsed very strongly and we went all the way down to the bottom of that spike. Similar pattern, a couple of legs up. The bulls are trying to get a high 1, high 2 setup, but at some point when we go below, rather than rely on your stop that's down here, a lot of traders saw that this was failing and this was probably going to turn into a spike and channel down. Other traders had their swing stop up here. When this broke, it's now in a trading range. And if a trader buys a high 2 in a trading range, they might decide to buy more lower and try and exit in break even. And then if that fails, they need to reverse to short. This is from last night's price action. Here's a bull channel. We've had a couple of legs down. Here's a high 2 buy that triggers. We immediately go below it. That's not great. Another possible high 2 signal here, but once again, the follow through is not great. We immediately go below that. And what happened last night, in my view, was that these two signals that should have worked, this is a strong bull channel, traders should buy here. As soon as they stopped working, we're in the process of a measured move down. So I think tomorrow, or tonight for me, when we open, I wouldn't be surprised if we get down to 59.50 or lower, because that's a high 2 failing. Well, thanks very much for watching. I hope you found that valuable. So there are 6 drills there to practice high 2s. It's a main part of my trading strategy. So I've tried to share all the drills that I practice. There are more you can do on high 2, but these are the foundation that I think are going to help you filter out the better trades from the weaker ones. They allow you to get into moves that are strong. They allow you to get into moves that are pulling back in a channel. They also allow you to quickly get out of a trade that's not working. It allows you to be flat to reverse to short if you need to. Thanks very much for watching. I hope you found that valuable. My name's Tim Fairweather from Zen Trading Tech. I'll see you in the next video.